Welcome to the Explainer. So, have you ever just stared at your savings account and thought, how do I actually make this money grow? Well, if so, you are absolutely in the right place. Today, we're laying out the ultimate roadmap to mastering your money. We are going to completely strip away all that confusing, intimidating financial jargon for good. And most importantly, we're taking you from an absolute beginner to a confident investor who's ready to make your very first trade. Now, that sounds like a trick question, doesn't it? But here's the harsh reality. If your money is just sitting there in a regular checking account, there is literally an invisible enemy silently eating away at your hard-earned savings every single day. That enemy? It's inflation. And it's exactly why we need a rock-solid plan to protect and, actually grow our wealth. Okay, let's dive into this. Here's our clear step-by-step map for today's explainer. Number 1, why you must invest. Number 2, the power of index funds. Number 3, timing, strategy, and risk. And number 4, placing your first trade. Section 1, why you must invest to beat inflation. So the truth is, the US Federal Reserve actually intentionally targets a 2 to 3% inflation rate every year just to keep the economy moving. But to truly feel what that slow drain does to us, let's look at a real-world example. Let's talk about Chipotle burritos. Just 6 years ago, a burrito cost about $8.50. Today, it's closer to $12. If you had $50,000 in cash back in 2019, you could have bought 5,882 burritos. But today, that exact same $50,000 only buys you 4,166. It's a genuine tragedy, I know. But think about it. That is literally 1,700 fewer burritos for the exact same amount of money. Yeah, it's a tough pill to swallow for sure. But it perfectly highlights how just leaving cash in a regular checking account actually shrinks your purchasing power over time. Your money isn't moving, but the cost of the whole world around it is just going up. So to beat this, we've got to make sure our cash is growing faster than the cost of living. And that brings us to the second big reason we absolutely must invest, which is the superpower of compound interest. You know the old saying, it takes money to make money? Well, imagine you take just $1,000 and invest it, getting a solid 10% return. After year 1, you make $100. Not bad. But in year 2, you're earning 10% on your new total of $1,100. If you repeat this every single year for 20 years, and get this, without adding another single dime of your own money, that initial $1,000 turns into $6,727.50. Your money literally begins doing the heavy lifting for you. Over the past 80 years, the stock market as a whole has historically returned about 8 to 10% per year. To put that kind of leverage into perspective for a second, if you had invested just $100 into the broader stock market back in 1980, it would be worth over $17,000 today. Even after you adjust for inflation, your wealth would have multiplied 44 times over. Insane, right? Section 2, the power of index funds. Set it and forget it. So the stock market is clearly the place to be. But before we get into the specific funds, we really need to understand why stocks are so great for beginners compared to something like, say, real estate. The answer is liquidity. Think about it. If you buy a $500,000 house in cash and decide you want to sell it next week, it's a massive hassle. It'll take 30 days or more. But the stock market? It's highly liquid. You can buy a share of Coca-Cola in the morning and sell it in the afternoon, instantly converting your investment right back into cash. Now, I know what you're thinking. What stocks do I pick? Well, trying to pick individual winning stocks takes a ton of research and carries a lot of risk. Just look at a company like Intel. They still haven't recovered their peak price from the year 2000. It's a real cautionary tale. Instead, everyday investors like us should really look to index funds or ETFs. Think of an index fund as the ultimate set-it-and-forget-it tool. Instead of paying a professional manager high fees to actively guess which stocks are going to win, an index fund automatically buys a tiny slice of all the companies in a specific market, like the S&P 500, which is just the 500 largest US companies. Boom, you get instant diversification with incredibly low fees. Okay, so to actually buy one of these index funds, you're going to need to know its ticker symbol. Think of it exactly like an airport code. You know when you fly into JFK in New York, the code is JFK? Well, the stock market works the exact same way. Every public company and fund has its own unique 3 or 4-letter identifier. Apple is AAPL, Microsoft is MSFT, Tesla is TSLA, and the ticker symbol for a very popular index fund that tracks those top 500 US companies, which, by the way, is the exact one we'll use for our live demonstration in a minute, is VOO, the Vanguard S&P 500 ETF.
Section 3, timing, strategy, and risk. How to keep buying.
Knowing you have the right vehicle is fantastic, but you kind of need to know which garage to park it in, right? First, you need an investment account. You generally have two choices here. Retirement accounts, like a 401k or an IRA, offer massive tax advantages. But the trade-off? Your money is pretty much tied up until you retire, which is actually great if you want for savings. On the other hand, you can just open a standard regular brokerage account. These are highly accessible, meaning you can withdraw anytime, but you are going to pay taxes on your gains. Ultimately, you choose whichever fits your own lifestyle and goals.
Next up is the terrifying question of timing. Beginners often wait on the sidelines because they think, oh, the market is too high right now. But look at this staggering data. The market actually spends about 21 days a year at all-time highs. If you sit in cash waiting for a dip, and you happen to miss just the 10 best days in the market over a 30-year period, your total gains drop by 54%. Miss 30 days, you lose 83% of your gains. Literally, waiting on the sidelines absolutely destroys your returns.
And this brings us to a total golden rule from financial writer Nick McGilley. Rather than worry about whether now is the right time to buy, just keep buying. Decades of market data actually prove that even if you buy a stock when it is technically overvalued, if you hold it for a 20 to 30-year horizon, the historical returns basically always converge positively. Remember this, write it down. Time in the market is drastically more important than timing the market.
So, how do we actually execute this? Well, you can invest all your cash at once, that's called lump sum investing, or you can use the highly recommended strategy of dollar cost averaging. This is where you invest a fixed amount, let's say $1,000 every single month, totally regardless of what the market is doing. This completely removes all that psychological emotion. When prices are high, your fixed amount simply buys fewer shares. But when the market dips and prices are low, your money automatically buys more shares, averaging out your purchase price beautifully over time. It's a real game changer.
Section 4. Placing your first trade, step by step.
Okay, let's take all this newfound knowledge and apply it right now so you know exactly what buttons to push on your phone. When you open an app like Robinhood, Fidelity, or Schwab, you're going to see a few different order types. A standard market order simply buys the stock immediately at whatever the current price happens to be. But you'll also see something called a limit order. A limit order lets you set a specific maximum price you are willing to pay. Basically, the app will hold your cash and only actually buy the stock if the price drops down to your specified number. But honestly, to get started today, a simple market order works perfectly. Here is the exact sequence to place your very first trade in a modern brokerage app. Step 1, hit the search bar and type in our ticker symbol VOO. Step 2, top trade and select your order type. Step 3, you can choose to buy one whole share or simply buy a fractional share by typing in a specific dollar amount, like $100. Step 4, review the order and simply swipe up to submit. And just like that, boom, you are an investor, actually owning a piece of the 500 largest companies in America.
So we've covered the why, the what, and the exact how. The mechanics are actually pretty simple, but the psychology, that's where the battle is won. Your future self is waiting on the choice you make today. So what's it going to be? Will you leave your cash on the sidelines and guarantee a loss as inflation silently eats away your purchasing power? Or will you embrace the long-term leverage of the market, remove the emotion, and just keep buying? The choice is entirely yours.